UNLV Microcertificate Economics. Interest rates. Yeah. Every economic good in the universe has a price. That includes things you can touch and things you can't touch. That includes your car. It includes a haircut, and it includes money. The trick to this is like the trick to everything else. If you're a business and you're involved in this, you want to make a profit, and interest rates are going to tie into the profits, obviously, of the lenders and also the borrowers. So where do interest rates come from? Strangely enough, the answer would be supply and demand. So we want money. We need to buy lunch. We want to make transactions. We save in the various forms that our savings can happen in. Businesses need to invest. They need to make transactions. They need to buy paper clips. The interesting thing about interest is that a lot of the time we're doing things that are over time. United Airlines doesn't buy a $200 million airplane thinking they're going to make $200 million off of that airplane this year. They're thinking they're going to make, $20 million off of that airplane over 20 years. Every year, $20 million. And they're going to make $300 or $400 million, and they're going to pay the... Boeing very often does not expect them to pay the $200 million up front for that airplane. They expect that money to be borrowed, and then Boeing gets paid, and somewhere there's a financial intermediary again in between that's balancing that out. Interest is the factor that balances out the time element, these things that go over periods of time. It's the interest that's going to balance those out for us. The other side of this is supply, and interestingly enough, supply money set by the government. So we have this interaction of supply and demand, except that demand is a thing that's set by businesses and consumers, but the supply comes from the government. What's that going to mean? Well, that's going to mean that the government's going to have a lot of control over interest rates. So again, for the most part, the Federal Reserve is going to decide not each specific interest rate, but kind of the flavor of interest rates, the harmony of interest rates, whether they're low or high. And it's going to do that by changing the supply of money. And it also sets some basic rates. And again, we'll talk about this when we talk about the Fed next time. It's not our purpose right now. Our purpose right now is to start talking about how interest rates, why they vary, how they vary, and how they affect the economy. So how does the bank decide what to charge you? Well, there's a theory of this, which reality is always more complicated than the simple theory. But the bank needs to make money off of the money. And so there's a risk-free rate, what we would call the opportunity cost of money. And in general, that risk-free rate is going to be set by the Federal Reserve. So the Federal Reserve is going to say, here's the base where interest rates start. Okay? Then the bank needs to cover the risk of making a loan. There's a chance when it makes a loan, you're not going to pay it back. A house, there's a chance you're not going to pay it back, but generally speaking, the house is usually there still, right? Same with a car. We can repo the car. Credit cards are much riskier. So we would expect credit cards to have a higher interest rate to adjust for the riskiness of them. We would expect a big business to have a better, lower interest rate than you do because they're less risky. Everybody has a credit rating, right? I know what my credit rating is. Hopefully you know what your credit rating is. Those credit ratings are a measure of your riskiness. And the less risky you are, the better terms you should get. So the higher your credit rating, the lower the interest rate you should be paying. We'll talk about these payday loan people or rent-to-own people. They are in a very risky business, and they're going to charge really high interest rates. The other thing is long versus short. The longer the loan is for, the more risk, obviously, there is. And so long-term interest rates should be higher than short-term interest rates. And then lastly, the interest rate should cover inflation, even though obviously, as we're talking right now, it does not. The interest should cover the inflation part of the deal for the bank. So here's some interest rates right now. And again, these change by the second, so live with it. The federal funds rate, which is the lowest, public kind of interest rate on the planet, is 0.08%. The Federal Reserve's target is 0.25%. The Fed's about to raise that either to 0.5 or 0.75, and we'll see what effect that has on the economy. When we talk about these interest rates, we talk about something called basis points. 1% is 100 basis points. So you might say the Fed target interest rate isn't 0.25%. You might say it's 25 basis points. Or you might say the Fed is going to raise it by 25 basis points. The Treasury 3-month Treasury bill rate is 0.42%. The 12-month is 1.19. The 12-month is longer term. The 3-month T-bill is about as safe an investment there is. The 12-month is not quite as safe. And again, inflation, there's no inflation premium in there, obviously. If you are getting 1% interest on your money, but prices are going up by 7%, you're losing money, right? And we'll talk about that more in a second. The 5 years, 2.07. The 30 years, 2.48. The gaps between those are shrinking, and the shrinking gap, we call this the term structure of interest rates. This pattern where interest rates get higher as the time of the loan gets longer. That gap is shrinking. When it inverts, when the long term has lower interest rate than the short term, that's a signal of a recession, and we'll talk about that. Every recession in the since the end of World War II, every recession there's been an inversion of the term structure prior to a year to, 2 years prior to the recession happening. There was going to be a recession without the pandemic happening because we saw the term structure of interest rates flip in 2019, and that's when President Trump went to the Federal Reserve and started yelling at them to lower interest rates and do some other things because everybody knew that was the signal that a recession was coming. Mortgages are at 4, credit cards are 17-ish, depending on who you are and what credit card you have. Houses are obviously less risky than credit cards. What about these payday loan people? Well, if you borrow $200, I saw an ad on TV here, you borrow $200, it's only they say, $7 a week to borrow $200 for your week. Well, that's $7 a week is $364 a year. 364 over 2, that's 182% interest. And Nevada, some of the payday loan companies, the one I got this from, actually advertises that they're the lowest, which they are. Some of these payday loan companies are rent-to-own, like the Aaron's rent-to-own. Some of their interest rates are 300%, 400%. Okay? Because they're making very risky loans to people who might not even have a checking account or a driver's license kind of deal. So if I buy a house, the bank loans me $200,000 to buy the house. If that home value rises by 5% per year, the house is worth $362,000 in 10 years. I look at my house, right? I took out a 30-year loan on my house. My house is worth more than the total value of the payments that I'm going to make on that. And I paid it off early, right? You should always pay stuff off early. You get the 30-year loan to make the payments low, but then you pay extra, right? But the bank loses on this, right? The bank had enough money to buy that $200,000 house, that particular house. If you pay them back the $200,000, they can't buy that house again. They've lost. They could have had an asset that grew from $200,000 to $362,000. Instead, they made you a loan, which, right? Everybody with me here? The bank lost. It's a loser. So the banks have a couple of choices to protect themselves. One is to charge higher levels of interest, right? in times of inflation when they should be charging higher levels of interest, but the market doesn't let them. So what they do is they structure the loan. The first 5 years of my mortgage, if I hadn't paid extra, I only would have paid my mortgage down by $1,000 in 5 years. So I would have paid them, let's say, $60,000 over 5 years, those first 5 years. $59,000 of that would have been interest, and $1,000 of that would have been principal. The last 5 years would have been the opposite, where it's $59,000 in principal and $1,000 in interest. But I'm not going to get anywhere close to there. Okay? The bank is hurt by inflation, and borrowers are helped by inflation. And banks try to do things to compensate for the fact that inflation hurts the bank because they made a loan when inflation was low, right? You make a loan when inflation's 2%, and that loan is at 4%, you're making money, and then all of a sudden inflation's 7%, and right, you lost. Borrowers, normal people who borrow money, are actually helped by inflation. This inflation in house prices, inflation in general, it helps people who are way in debt. Okay? Think about it now. Let's say that you were making $4,000 a month and you took out a loan and you're paying $1,000 a month on a house. 20 years from now, maybe you're making $8,000 or $9,000 or $10,000 a month because of inflation. You're still only paying $1,000 a month on your house. Right? Inflation helps you pay off your house as long as your wages keep up with inflation. All right. Concept. Real interest. Remember that keeping it real, you've probably, you've heard rap people talk about that, and you never knew exactly what it meant when they said, hey, we're keeping it real. Real means adjusted for inflation. So these rap guys, they're smart, they're economical, they get economics, they're adjusting everything they do for inflation. They're keeping it real. Okay? The interest rate that you pay when you sign that thing on to buy your house and it says, hey, I'm paying 4%, that's the nominal interest rate. That's the money rate that you're paying. But the real interest rate that you're paying is that nominal rate minus inflation. So if you have a 4% mortgage right now, but inflation's at 7%, the real interest you're paying is 4 minus 7 is a negative 3. The bank is paying you for the loan. You're paying them back with dollars that are shrinking in value, right? Every payment you make, the dollar has less value than it did before. So your house is getting more valuable, the dollar is getting less valuable, and you traded the bank, right? Dollars for your house. So you're in something, an asset that's getting more valuable, and you're paying the bank back with assets that are getting less valuable. This does not make the bank happy. Banks are only happy with people who buy houses, hold them for 3 or 4 or 5 years, sell them, buy a new house, hold it for 3 or 4 or 5 years, sell it, right? People who live in their house a long time, or people who pay off their credit card bills every month, banks do not like those people. They like people who hold a balance on their credit cards and are constantly every 4, 5 years, 3, 4, 5 years buying a new house. Okay, we're good. Let's move on now and talk about how money affects the economy in general.